So this is called the balance of payments. Some people call it the imbalance of payments. So what it is when you have an economy, we have to keep track of where the money goes when it comes to international trade. So when we learned about the production possibility curve and comparative advantage, we found that economies should produce what they're good at and trade with other countries. And once they do that, we have to keep track of where the money goes. So anytime the money leaves, we have what's called a debit, just like when you swipe your debit card, the money leaves. And we have what's called a credit. If you return an item to the store, the money goes back in your account. So the balance of payments system is made up of the current account, which has 3 items, and the capital account. So these 3 items in the current account, they are net exports, which we know is exports minus imports, or goods and services. So this is by far the largest part of the balance of payments. This is where we get our trade deficit and trade surplus. So goods and services will come in and out of the country. Now, anytime that happens, say we buy something from another country. Now grab your packet that I gave you, or you got in class, and look at number 3. A Chinese company sells $1 million worth of berets to the U.S. Army. So that means that we bought something from China and our money had to leave for them to ship us that item. So we'd put a check in the debit column and it would be a check to the current account. So we had a debit to the current account based on the fact that goods and services had now left our country. The next one is net foreign income. So remember, this is the income derivation of GDP. So I abbreviate things, net foreign income. This is all the money that's earned abroad and sent back home, or the money earned here and sent out to other countries. So back to our packet right here. An example, each month, a migrant who recently arrived in the United States sent half her paycheck to her sister in Poland. So where did the money go? Well, it left the country. So that one is a debit to the current account. Our third item that we have is going to be net transfers. Now, transfer payments are things like Social Security, foreign aid, Medicare, Medicaid, disability, things like that. Now, if we make transfer payments, we are simply transferring the money and not actually purchasing anything. So when we have transfer payments, what we get are the sum of all those transfers of money. So what we'd like to do first is add up our current account. So now if we head over to this next page. Now on this page, it's the back of the one on the grid, page 659, or I'm sorry, it is actually page 303. Okay, so page 303 on your packet. What we have now is Z-land. We have exports of goods, imports of goods, exports and imports of services. So the balance of trade, these items together make up our net exports, or exports minus imports. So these goods and services, we'd want to add them all together, and we get a balance of trade. So if we add these all together, we get negative 70. So now what we have to decide, is this a surplus or a deficit? Well, since it's negative, that would make it a deficit. So Z-land is carrying a balance of trade deficit because we have a negative. So now this portion of the current account, remember we have our 3 parts of the current account. We have net exports, net foreign income, and net transfers. So what we need to do now is total up the current account. So we have our net investment income, maybe something that came in from overseas, that's a positive, so that's a credit. Net transfers were a negative, so that's a debit. So if we add these two together, we have a minus 4. So now let's sum up our current account itself. So minus 70 and minus 4 is going to give us a negative 74. That is for the balance on the current account. So now the current account itself is in deficit. Forgot that I right there. So the current account is in deficit. Now let's go back and visit what the capital account is. So we have the capital account, which can be net foreign investment. So investment, remember IG is gross private investment. And investment is going to be something that's capital. It used to be called a financial account. So the financial account, think about our types of capital. We have real capital, we have financial capital, human capital, and all those add up to our capital stock. So when we have our capital account or financial account, those are going to be investments. Think to yourself, is it something that's used to make money or something for personal use? So what we're looking for when it comes to the capital account is something that you'd be considering an investment. So those investments will need to be something that are used to purchase capital goods. Remember, capital goods make consumer goods. So the first one is done for us. Harley-Davidson USA purchased $25 million in production machinery from a Japanese company. Well, the money left the country, it went to Japan, so it's a debit and to the capital account, because the capital account, they're using production machinery to make motorcycles and sell them. So that is an investment, and we consider it part of the capital account. Okay? Now we can work through all of these. Entrepreneur, a U.S. entrepreneur, invests $50 million in a theme park in Malaysia. Where did the money go? It's a debit because the money left, and it's capital account because the theme park is used to make money with. BMW pays $1 million to a U.S. shipper for transporting cars from Germany to the U.S. Well, BMW is a German company, and shipping is a service. So once again, the money, where did it go? They paid it to a U.S. shipper. So now we have a credit to the current account because that's goods and services. We already did number 5. Number 6, Bank of America pays $5 million in interest to French depositors. Well, the money is leaving our country, so that is a debit. And depositors are earning interest, so that is, if we go back to here, that is net foreign income. Look, interest, nominal interest rate, the lowercase I of the current account right there. So that is interest income. So that is going to go into the current account as well. Senor Ramos from Spain buys a shopping center in Florida. Well, where did the money go? It came in from Spain, and that is to the capital account, because the shopping center will be used to make money. A Brazilian investor buys 5 $10,000 U.S. savings bonds, or treasury bonds, or T-bills. Okay? So the money is going to be a credit because it comes into the U.S., and the U.S. will take that money to buy infrastructure or things like that, and that goes to the capital account. Remember, bonds are financial, so think financial or capital account. Now, German tourists spend $3 million in the U.S., the U.S. spend $5 million in Germany. So the $5 million exceeds the $3 million by $2 million. So more money left than came in. So that would be a debit to the current account. I'm going to skip this one because I think there's 2 answers. I don't like it because $10,000 in CDs is an investment in inventory, but the answer key actually says current account. So the last one, Sam Boney, a U.S. ice rink magnate, buys stock in a Chilean ice rink chain. Well, the money went to Chile, didn't it? So that's going to be a debit to the capital account because they put their money into something somewhere else. So now what we can do is we can go back to Z-Land. Let's check out our capital account. So we have capital going abroad, that's money leaving, and capital coming in, that's a credit to the capital account. So minus 110 and plus 160 is going to be a positive 50. So that positive 50 is going to be a surplus to the capital account. So now remember this, anytime the current account's in deficit, the capital account's going to be in surplus. If this one's in deficit, that one will be in surplus. They're always going to be opposites and offsetting. Okay? So now what you do is once you have these things, what we're going to do is we're going to add them together. We're going to add them together, or net. So on our current account we had minus 74, and our capital account we had a plus 50. Okay, those 2 things were what we solved for on Z-Land. And what we need to do is we're going to equal them with our official reserves account. Official reserves account. So the official reserves account is a place where the United States can stockpile foreign currency, or it can borrow from for the next year. So there's 2 things we can do. If we have a surplus or a deficit. So now what we have to make this zero out at the end of the year. So at the end of the year, we take our current account and capital account, we add them together. So the balance of payments account itself is in deficit of minus 24. So if it's in deficit, we're going to have to borrow or use cash from last year's official reserves account. So that means what we would end up doing is we end up putting a plus 24. We had our negative 24 for the balance current account plus capital account. So the official reserves transaction balance, we would need a plus 24, and then we could equal 0, and that's our goal right there. So what would happen if it was actually in a surplus? Well, if it's in a surplus, you're going to stockpile foreign currency. So on the balance of payments, if it's a surplus, you save the cash for next year and zero it out. If it's in a deficit or negative, we're going to borrow or use money from last year's official reserves account to zero it out. That's the whole point of it. Okay, so now we can have our balance of payments.